Welcome to the 8 Steps to Financial Fitness series of workshops with Old Mutual. My name is Sachaba Gleba and I am your host. So in our previous workshop, we spoke to Sboniso about what qualifies as an asset and what doesn't. And I think we were all shocked. We had to go home. We had to list up all the things that we own and really try to get to the bottom of whether they are assets or not. So today we're going to speak about one other thing that is involved with investing, and that is risk. It can happen. It may happen, it may not happen, but we hope it wouldn't happen. And the perfect person to take us through this is Michael Dodd, who's the head of equity at Old Mutual Multi-Managers. Welcome.
Thank you, Sachab.
So Michael, we're speaking about the three levers of investing: diversification, risk, and time. And I think when we speak about investing, this is our hard-earned money. If we're going to be investing it, we're hoping nothing terrible will happen. But why do we automatically think that way?
Well, I guess we're humans and we're programmed to think that way. And I think in just the everyday conversation when we talk about risk in sort of our day-to-day lives, we're thinking about, the scary stuff where something bad can happen, crossing the street, encountering a snake or a spider or something like that. To us investment people, risk is a far broader and a far different and actually quite complex topic. And it's something that we could talk for days about because it's such a broad topic where so everyone has their own different definitions of risk. But I think more commonly when we talk about risk in the context of an investment and in the context of your assets and all of that, we're talking about effectively how much the value of that is moving around on a day-to-day, week-to-week, month-to-month basis. And what we commonly call that is volatility. Now, when you own a single stock, when you own one stock in one particular company, that can be quite volatile. That moves around quite a bit on a day-to-day basis, and it moves around intraday as well. So during the day, the price can go up and down. And when we talk about the management of risk and the collection of all of your assets, we commonly refer to that as a portfolio. Now, the way to think of a portfolio is, effectively think about it like your wardrobe. Your wardrobe, you've got your clothes for work, you've got your clothes for, play, for gym, for sleeping. It's a broad collection of effectively all of your clothes, and they're all there and they all serve a completely different purpose. You're not going to go to the gym in a suit. They all
Let's hope not.
They all do different things. And effectively, when it comes to risk management, in investing, sometimes you need to take risk. And, because ultimately, some of the assets that we perceive to be the most volatile and the assets that are the most risky are sometimes the ones that come with the greatest reward and give you the greatest return.
Apologies to interject, but would an ordinary day-to-day person know which ones are deemed as risky and worth venturing into? Do you understand what I'm saying?
Yeah,
not everybody would.
I'm guessing the ordinary day-to-day person might think that something is less risky than it actually is. And generally there's a spectrum to these things. So as we spoke about the asset classes the last time around, your cash, that's generally viewed as your safe haven. Okay. That's the least volatile. It just grows incrementally on a day-to-day basis. And then as you move up the spectrum, you get to things like your equities, your shares in the stock market. And those are the things that are can be quite volatile, but also are the things that over time should be the things that provide you with the highest return. Okay. And in the context of a portfolio where you have, your cash, your bonds, your property, your equities, all of that together, the most effective way to manage risk in that particular context is through diversification. Okay.
And what is diversification?
Yeah. So diversification is basically the fancy investment way of saying, don't put all your eggs in one basket.
Okay. So
or don't put all your lemons in one bowl.
Literally that. Okay.
So, and diversification effectively gets called, has been called in the past the free lunch when it comes to risk management, in the context of investments. And what diversification is effectively doing is it's spreading the risk. So rather than investing in one single particular, security or asset class or that sort of thing, it's taking all of your money and putting that across and sort of spreading the risk, across the range of assets.
To ensure that, when something happens, you don't have all your eggs in one basket.
Exactly.
The basket crashes for whatever reason, and
so the stock market, as we've mentioned, has its up days and its down days. And you need to have things in your portfolio that are moving in different directions.
Okay.
And are offsetting that. So when you have your inevitable down day with all of the shares that you own, and that's down on a particular basis, you have cash in your portfolio that's holding steady and is sort of growing. And the way to think about it in a nice analogy is to think about a flock of birds. Because ultimately the stuff that you have in your portfolio, you want it to be moving in different directions, but ultimately as a whole needs to be moving together. And if you think about a flock of birds, if you focus on just one particular bird, if you're just looking at one bird, the movement there can be erratic. If it can be all over the place, you don't know where it's going. But if you sort of widen your gaze and look at the flock as a whole, it's far more graceful, it's far smoother, it's all moving in effectively the right direction.
But obviously you'd be doing this with the guidance of someone that does this professionally, because then we're wondering, what is this flock of birds? You know what I mean?
Yeah.
And when you say portfolio, what do you mean?
So the portfolio is just that. It's that collection of all of your particular assets. So the asset classes that we spoke about the last time, the bonds, the cash. So everything that you classify as an investment, that is your portfolio.
Okay. Is offshore investing a form of diversification?
It is.
Okay.
Absolutely. So I mean, we've spoken about the asset class diversification, and investing offshore we would classify as what we call geographic diversification. And the world is a big place. As much as we love South Africa, we're all proudly South African. South Africa is only 0.5% of the world's markets. And by diversifying offshore, you can have exposure to companies in the US and the UK and Europe and other developed markets. You can expand into having your money in emerging markets like China. You can have your money in frontier markets, so across the rest of Africa.
It sounds unattainable though. When we speak about investing and working locally, now you're talking international and global. How would one go about pursuing this?
So there's numerous ways that you can do it. Within I suppose as an individual investor, you can buy shares offshore. If you have an account with a stockbroker or something like that, they can, through those, you can access international markets, and you can actually buy the Apples and the Facebooks and the Netflix and all of the shares in these international companies that have been flying for the last few years. In a more simpler context, if you're investing in a unit trust or a balanced fund that is run by a South African asset manager, they have the ability to allocate money offshore, on your behalf, as well. So you can effectively outsource that scary decision to a fund manager who is making that allocation on your behalf.
So you've taken us through offshore diversification, but are there other ways of diversifying?
There are. So Charlie, you're right. There are so many levels to this. And it's levels or layers if you want to talk about an onion, and as you sort of peel it back. So you can start at the bottom rung with your individual securities and your individual diversification, so owning different types of stocks. And then one next level higher is you can talk about, in the context of something like an equity portfolio, sector diversification. And that's where you own stocks that play in different areas of the market, that play in different industries, are driven by different factors. So things like your technology companies are going to be driven by very different things to your banks, are going to be driven to different things like your mining companies. So that's at a sector level. We've spoken about offshore and geographic. We've spoken about asset class diversification, then the next level higher, where you have all of your equities, your bonds, your property, all of that together, because they also ultimately move in different directions and have very different characteristics that drive them. And at Old Mutual Multi-Managers, diversification is one of the cornerstones to our investment philosophy, and we take it one level higher in our team, where we then diversify at an asset manager level. So allocating money to those asset managers, both locally and globally, that we feel are the best fit for managing our clients' money.
And is there such a thing as diversifying too much?
There is. And it is possible to over-diversify, and in investment terms, sometimes we call that diversification.
Okay.
And we see that quite often as Old Mutual Multi-Managers, where we select asset managers on our clients' behalf. We often see with investors, they've put too many funds together that are effectively all doing the same thing and aren't bringing anything different to the mix. So the way to think about it in a sporting analogy is, imagine you're the manager of a football team.
Okay.
And you select your starting 11. And your starting 11, you pick your goalkeeper and you pick 10 defenders. Now, technically that is a team. It's very defensive. You might not concede many goals, but you probably need to throw a striker in there and have someone on the pitch that's going to score so you can win. Right. So that's, one of the analogies around.
You lost me at sport, but go ahead. All right. So how does time make investing less scary, basically?
Yeah. So time isn't just an important concept. It's the most important concept when it comes to investing. And we spoke about it in the previous session, the difference between saving and investing. Where saving is more of a short-term exercise. With investing, you're in it for the long haul. It's your marathon, not a sprint, for the runners amongst us. And time is so important when it comes to risk management, particularly when you're thinking about things like the equity market. Because we live in a world where we thrive on instant gratification. We can hit refresh on our investment statements, and our balances can update to the minute. And when you're looking at that, and if you're looking at it too frequently and too much on like a day-to-day basis, and if you see a down day when it comes to markets, that can hurt you emotionally. And being able to have that power to look at your balance is incredible, but it's also incredibly distracting. And on those down days, that's where your emotions can get the better of you. And when that happens, that's often the time when we make the worst decisions, and we take ourselves out of the market when really we should be sitting tight and just acknowledge that these things happen. So time is your friend when it comes to investing, because it allows you to ride through those ups and downs and through the market cycles, and effectively to allow your investments to compound over time and to grow.
And what advice in closing would you give someone who is leaning on how this is so scary, but wanting to venture into investing? What would you say to them?
Well, I think the first thing to say is that it might seem scary because it is your money, and that's important to people. But at the end of the day, it's actually relatively simple to minimize your risk, or to manage your risk within a whole investment portfolio context. And that can be done through aspects like diversification, and not having everything sitting in one particular area and spreading the risk. Because ultimately, I think as much as we would all love a crystal ball, no one knows what the future holds.
Yeah.
And what might be the best thing to own in one year might be the worst thing to own in the next year. And rather than betting on one single outcome, you want to effectively spread the risk and ensure that, should things not go right with one area, you've got something else that is working on your behalf. It effectively reduces the FOMO in your life.
All right, so Michael took us through the process of diversification when it comes to investing, not putting all your eggs in one basket, and most importantly, not focusing too much on the ups and downs. Remember, we're linking this to physical fitness, and when you're on a physical journey, you take it step by step and day by day. So you need to do the same with your financial journey. We'll be back with the next workshop.